Hey, Warren William here for Smartest Data. The collapse of Silicon Valley Bank on Friday was the second largest bank collapse in US history as the US regulators, the FDIC, shut down the bank. As usual, the final act in the collapse of a bank was triggered by a run on deposits as depositors withdrew cash over $42 billion. But what really happened here? First off, the CEO sold 3.5 million in shares in January. For me, this is insider trading, so will the SEC investigate? Is there systematic risk to the banks in the US? And then also, when is the ongoing diabolical failure of management in the tech industry going to stop? Let's go to the video. So let's start our investigation into SVP with a few key takeaways. In January, the CEO sold his stock worth $3.5 million. What did he know and when did he know it? SVP was forced to abandon its plans to raise new capital. Why? The demise of SVP appears to be an isolated event. Is it? One key issue and failure are securities classified as held to maturity. Is this a systematic risk factor for the US banking sector? Look, all this appears to be a classic failure in bank risk management, thus it is game over for SVP. At the core is a cocktail of an accounting fix and rising interest rates. I'm not going to dance around the issue at SVP. First, there appears to be a case to investigate for insider trading. Let's cut to the chase. The collapse of SVP was not created last week. There was one critical issue and an epic failure in bank risk management, which led to the demise of SVP. All this seemingly aided by a systematic level of ignorance about enterprise risk management within their client base. Okay, and while I'm at it, why not lay some blame at the door of the Fed? But it's not what you think. Before I get into all this, let me address what I think is the biggest issue, and that is the potential criminal activity by SVP CEO. I believe in January, Gregory W. Becker sold 12,451 shares with a trade value of over $3.5 million. This appears to be classic insider trading. The CEO would have had to have known about the paper loss on a mark-to-market basis on the US Treasury's portfolio, securities classified as held to maturity. Okay, it is only a paper loss. That is until the loss is crystallized when SVB had to generate cash to pay out deposits because there was a run on the bank. Ultimately, that loss amounted to $1.8 billion. I would expect an investigation is to follow by the SEC, and I believe it is quite possible that charges could be filed. Of course, everyone is innocent until proven guilty, but on the surface, this does not look good. I'm certain that the SEC will pursue an investigation. If found guilty, the maximum fine is $5 million and 20 years in jail. I really want to emphasize that before investing in any stock, check for insider activity. The financial database I use is called FinScreener, and here the trade is clearly noted. Do your due diligence. FinScreener is a great tool, and never invest in a stock if you see this, ever. What were the events that broke the camel's back? First off, midweek, SVP announced the capital raising of $2.25 billion in a combination of common and preferred stock. This is Tier 1 capital, and it's required to stabilize the $209 billion balance sheet. Second, the key was that SVP had incurred a loss of $1.8 billion on the forced sale of over $21 billion in fixed income securities. Third, the stock market was taken back, not expecting this, and the downward spiral began. On Friday, SVP stock price collapsed more than 60%. Fourth, the demise was not only in the stock price, but also depositors also withdrew an astounding $42 billion in cash, or 20% of SVP's total liabilities. Then fifth, the California regulator agency confirmed that SVP was insolvent due to insufficient liquidity with a current negative cash balance of $958 million. By Friday, SVP was forced to abandon its plans to raise capital, and the FDIC stepped in and the search began for a new buyer. So is there systematic risk in the US banking sector? First off, the financial strength across the US banks is strong. The banks are well capitalised, even overcapitalised. Let's discuss the accounting fix or entry that allows banks to classify investments as hold until maturity. These are securities that are categorised as long-term investments on the bank asset side of the bank's balance sheet. Banks typically do not venture much beyond US Treasuries because of the capital requirements involved. In the case of Silicon Valley Bank, they were taking deposits, but the typical banking activity such as lending was minimum. Before I get into the guidelines, I want to discuss what is a deposit for a bank, and I want you to grasp the tenor mismatch that occurred here between bonds held to maturity and deposits. For a bank, a deposit is a liability. Deposits fund the asset side of the bank's balance sheet. In effect, as a depositor, you are a government guaranteed lender up to the $250,000 guarantee. After this, you are a creditor to the bank. In bankruptcy procedures as a depositor, you are certainly senior to shareholders. The pecking order compared to other stakeholders will be detailed in the fine print of the bank's documents. In short, as a depositor, you are very likely to be an unsecured creditor to the bank. So good luck. If the bank experiences a run on deposits as SVB did, a bank could have to sell securities as SVB did, and the realised loss as mentioned was $1.8 billion. So let's take a recap of Silicon Valley Bank. Silicon Valley Bank was founded back in 1983 and is focused on commercial banking, asset management, and investment banking services. It's headquartered in Santa Clara, California, but has only 16 branches, so its business is quite specialized and is centered on tech and biotech industries, and also included in this was the client network, the venture capital funds, and private equity funds. Their roles is to provide startups and early-stage companies in these industries, tech, biotech, with capital and managerial guidance. SVB had been a popular choice or even the go-to bank for startups and growing tech, biotech companies. Many of these companies are in the cash burn phase or yet to make money, or due to the downturn in business have been pushed back into the cash burn phase. Thus, over the past 5 years, SVB was able to quadruple its assets, and just over 12 months ago, market cap exceeded $44 billion US, or a far cry from Friday's market cap at the close of $6.3 billion. Further complicating the situation, the market value of SVB's bonds plunged to around 45 cents on the dollar for the senior debt, and the junior debt is practically worthless, falling to a low of 12.5 cents. If a financial savior is not found, the SVB bondholders are facing substantial losses. The key issue is that many companies, and some could be the clients of SVB, may not have been viable in a normal interest rate environment. Funding growth for all companies becomes a very different exercise when the cash rates move from around 25 basis points to 5%. So let's discuss, is SVB an isolated event or possible contagion within the US bank sector? Certainly the collapse has highlighted how the ending era of cheap or free money is exposing vulnerabilities in the market. Interest rate tightening by the US Federal Reserve and other central banks to fight inflation is set to continue. Thus, the combined impact of rising interest rates and SVB sent bank shares tumbling over the past week. All in all, it is estimated that US banks have lost around $100 billion in market capitalization, with the four major banks combined losing about half of this, or $53 billion in market value. Many US regional banks such as First Republic Bank, Signature Bank, and Western Alliance stated that the liquidity position and deposit base remains sound. Certainly, there is a domino effect regarding the bank's share prices. However, the SVB situation is not common to other banks, such as the savings and loan crisis in 2008. This led to the demise of Washington Mutual. So what will happen to Silicon Valley Bank? Look, as a bank, it's game over as a bank holding company. The FDIC has taken control and eventually the bank will be sold. Looking back to WAMU in 2008, when the FDIC seized the bank and JP Morgan Chase purchased the assets for about $1.9 billion. The FDIC, the US agency that insures bank deposits up to $250,000, and they announced that depositors would have access to their funds by Monday. Initial comments implied that it's only a few deposits in this category, around only 4%. In December 2022, Silicon Valley Bank declared that nearly 96% of the US $173 billion in deposits were not covered by FDIC insurance. The greater portion of SVB's clients were startups in the tech, biotech, or venture capital or PE funds. Their account balances exceed the FDIC's maximum coverage amount. They are not covered by the $250,000 maximum or over and above that. In all likelihood, these depositors will receive an initial payment next week. All outstanding amounts above this will greatly depend on the disposition of SVB's assets. So far, not looking good. So let's discuss the incestuous nature of the business base in Silicon Valley. As a regional bank, and a large one at that, being the 16th largest in the US, SVB had a very specialized client and business base. The bank's clients all knew each other and many had deep pockets, so lots of cash looking for an investment. This allowed SVB to demonstrate the explosive growth over the past 5 years as mentioned above. However, as business conditions turned due to rising interest rates and layoff in the tech industry increased, this incestuous client base became somewhat of a liability. No one in Silicon Valley, or anyone else for that fact, wants to be stranded on the beach as the tide goes out, and the word was out, Silicon Valley Bank was failing. I believe this is a classic failure in risk management. The current phase of rising interest rates hurt Silicon Valley Bank in two ways. First, their clients suffered a downturn in business, which in turn, as their clients reduced spending due to fears of a possible recession. Second, there was a peculiarity in the SVB business that led to its demise. The traditional business of a bank is to raise deposits and make loans, thus generating net interest income. SVB did not have an extensive loan book because Silicon Valley already had an extensive funding source via venture capital and PE funds. Instead, SVB invested in government bonds, and as the Fed raised rates, the value of these bonds declined, suffering paper losses. That was until these paper losses crystallized as SVB reclassified these securities and became a forced seller of these bonds. SVB had no other option available to fund their deposit withdrawals. Now the vicious cycle and the downward spiral had begun. The fact that SVB had lost some money was not lost on the incestuous environment in Silicon Valley. SVB appeared to be vulnerable and financially unstable. Fears grew amongst clients, deposits were withdrawn, more bonds were sold, recording ever-increasing losses, and the cycle continued. So on to enterprise risk management. Any company, small, medium, or mega, must incorporate enterprise risk management practices. Enterprise risk management is a strategic approach to identifying, evaluating, and managing enterprise-wide risk. The process involved a comprehensive and integrated approach to the management of all types of risk, not only financial but operational, strategic, and compliance-related risk. From the SEC filings, companies impacted by the collapse of Silicon Valley Bank range from startups to large firms to publicly traded companies. The list of companies include Roku, Roblox, and Quotient, and many others. In the Roku case, the SEC filings indicate the amount deposited with Silicon Valley Bank was around $487 million, or around a quarter of its cash and cash equivalents. In the case of the clients of SVB, enterprise risk management was at best a passing consideration. In the case of Roku, deposits should have been spread across many more financial institutions. Clearly no comprehensive and integrated risk management strategy was implemented at Roku. The enterprise risk management was at best non-existent, and the decision-making process at a listed company was frankly a debacle. So let's move on to bank capital and leverage. In order to satisfy the requirements of regulators, investors and rating agencies, the US banks tend to aim to maintain a high level of capital. Of course, the average leverage ratio for US banks can vary widely depending on the size and business model of the individual bank. The ratio is a measure of the bank's capitalization and in turn financial strength. The leverage ratio is calculated as the ratio of Tier 1 capital to its total assets. The Tier 1 capital is comprised of the bank's common equity and retained earnings, altogether shareholders' funds. The level of shareholders' funds that are committed to a bank shows the level of commitment of shareholders. SVP was endeavouring to raise Tier 1 capital last week. As of 2021, the average leverage ratio for the large US banks is around 10%, according to data from the Federal Reserve. This is higher than the regulatory requirements, demonstrating their combined financial strength. The US banks are well capitalised. Banks are required to maintain a leverage ratio of around 4% under regulatory guidelines. This can vary widely depending on the specific bank and the business model. Regional or community banks may have higher leverage ratios due to their focus on traditional lending activities and lower risk business models. Conversely, large investment banks have lower leverage ratios due to the focus on trading and other high risk activities. So if you like these videos, please like and subscribe. It really does help the channel. I think this is an interesting case. I think the insider trading issue has been largely overlooked. But as I say, like and subscribe, and also take a look at the blog, www.smartest-data.blog. There's a QR code on the screen. See you in the next video.